For another round of Good Day saves in an alarming new study finding a third of U.S. adults reporting financial insecurity and nearly half of moms revealing they have little or no retirement savings.
Yes, an eye-opening report for sure. So here to offer some financial guidance is the author of Superwomen Wealth, How to Become Your Own Financial Hero, Regina McCann-Hess. Regina, thank you so much for joining us. First things first, let's talk about this report and really how disturbing and real it is to so many.
It is actually very real because we're so busy taking care of the day-to-day tasks and we forget about ourselves. I mean, as a mom myself, I have worked 2 or 3 jobs in one day. I get up, I take care of the kids, I get them off to school, then I go to my job that actually pays me, right? And then I come home and do the same thing again. And what we forget to do is take care of ourselves, and financially very important because money is going to be so important for women because we live 5 years longer than men.
Yeah, no doubt. Moms definitely pull double duty.
Yes.
You have some tips for women when it comes to financial security, one of them being pay yourself first. What do you mean by that?
So when you are working, you should definitely contribute to the 401k plan as soon as you're eligible for that. And that's easy because you don't see the money coming out of your paycheck once it's out of your pocket, you're not used to spending it. So what you do there is you contribute as much as you can. Obviously, I want everyone to contribute the maximum, but reality says we also have to pay our bills, right? Mm-hmm. So that kind of leads into the second part of that is that every time you get paid or a pay raise or a bonus, I go to the 1/3 rule, which says 1/3 of that bonus or pay raise goes towards increasing my retirement savings, 1/3 goes towards rainy day savings, and 1/3 goes towards pat yourself on the back. You did a great job. You can spend some of that money.
And a little bit of self-care in there somewhere because moms certainly need it. Talk, though, about the retirement savings and some of the options beyond just your 401k that more should consider.
Yeah, most plans at this point, retirement plans, whether they're 403Bs or 401Ks, they offer the traditional 401k option, which is, you get a tax deduction and then that money goes towards your retirement plan. But most also offer a Roth version of that plan now where you pay the tax today and it goes into that 401k plan and it grows tax deferred just like the other traditional plan. But the difference is when you take it out in retirement in the Roth, you never pay taxes on that money again, federal taxes. And, it's basically, do you want to pay the tax bill now or do you want to pay the tax bill later? And my thoughts are the tax bill now is going to be a little less because that money grows over all that time. So there's an abundance of, money at the end that you won't have to pay taxes on.
Right. That's some good advice now. So you got to analyze weigh which one is better for you. Look, I've heard of this term called the bucket approach. I've heard of that before, but break down what we need to know about that because it can be a little convoluted.
Oh, absolutely. And when you think of it, it can simplify a lot because financial stuff seems to be a little like, oh my gosh, scary, right? But if you do the bucket approach, it's a little bit more friendly. So first bucket is your rainy day savings, your next 6 months of, what if something happens? And that should be money that is relatively risk-free, like your CDs, your FDIC, insured savings accounts, things like that, money at the bank. And that's like your 1 to 3 year window for money. The next bucket number 2, is your income bucket. That's where you're going to have a little bit of maybe bonds or things that throw off income. And that can have a little bit of risk, but you're not going to touch that money for 3 to 5 years. And the income that funds that bucket or comes out of that bucket goes to fund bucket number 1. Bucket number 3 is your long-term money. That's your retirement money. That's money you're not going to touch for 10 plus years. That's where you can take your risk because if the market goes down tomorrow, you have plenty of time for that money to recover. And I should say when the market goes down because it will go down.
Well, Regina, thank you so much for your help, for your information. The insight is super helpful. Also, the author of Superwoman Wealth, How to Become Your Own Financial Hero. Thank you. Your time